Welcome to this explainer. Today we're unpacking a really fascinating paradox. It catches some of the absolute most responsible people out there. You're doing everything right by saving, right? But somehow you're still actively losing wealth. Let's figure out why that happens. Imagine you finally get serious about your money. You cut out the impulse buys, you skip those expensive artisanal lattes, and you actually start saving a solid chunk of every single paycheck. And honestly, for the very first time, you feel like that financially responsible adult you were always promised you'd become.
And it feels incredible, doesn't it? One night you open up your banking app and boom, there it is. A solid $15,000 sitting perfectly safe in your savings account. You put in the hard work, and there's the undeniable proof staring right back at you, completely insulated from risk.
But look a little closer. After an entire year of keeping your hard-earned cash in that account, the bank paid you just enough interest to buy, maybe a couple of coffees? And when you factor in the silent thief of inflation, your purchasing power is literally shrinking. Meanwhile, everywhere you look online, the conversation is all about compound growth. So suddenly, you find yourself asking this exact question. Wait, am I missing something? Well, let's dive into this. Because the harsh truth we need to unpack today is that while saving money is absolutely crucial, saving alone usually doesn't create real wealth. And honestly, most people get stuck right here because nobody actually explains how to transition into investing without relying on a ton of complicated Wall Street jargon. Let's look at Section 1, the savings illusion. Which brings us right into Section 2, defensive versus offensive money. To break free from that savings illusion and understand how wealth is actually built, we really need to recognize the massive difference between simply protecting your cash and actively growing it. Saving money, that's playing defense. It protects your future. But investing, that's playing offense. That is how you actively build your future. We need both, absolutely, but they do completely different jobs for your financial well-being. So what actually happens if you only play defense? That brings us to Section 3, the cost of waiting. Let's look at some numbers because this is where it gets real. Imagine you keep $10,000 in a regular savings account earning around a 1% interest rate. After 1 year, you've earned $100. Cool. But if that same 10 grand was invested at a historical 10% US stock market average, that becomes $11,000. It's a $900 gap. Noticeable? Sure, but maybe not life-changing yet. But watch what happens when you zoom out 20 years. The opportunity cost becomes absolutely staggering. Your savings sit at roughly 12 grand, but your investments, they've ballooned to roughly $67,000. Time literally changes the math entirely. So the absolutely crucial takeaway here is that the real wealth gap in our society isn't always just between the ultra-rich and the poor. Very often, that gap is simply between people who only know how to save and people who have learned how to invest. Okay, let's move on to Section 4, the 5-step wealth roadmap. Now, I completely get it. Investing feels really scary at first because the market bounces up and down while your savings just stay nice and stable. So to make this transition without all the anxiety, we use a simple roadmap: emergency fund, mental buckets, starting small, keeping it simple, and consistency. Let's break these down. Step 1 is building your emergency fund. Before you invest a single dime, you've got to save 3 to 6 months of living expenses in cash. And this isn't just about paying for flat tires or surprise medical bills. It's a psychological buffer. It literally stops you from panic selling your portfolio at a massive loss when life inevitably throws a curveball at you. Step 2 is actually a brilliant little piece of behavioral finance: creating mental buckets. One bucket is your locked-in safety money. The other is your growth money, which you actually expect to fluctuate. Drawing this distinct line instantly neutralizes the stress of market volatility because you finally stop treating every single invested dollar like it's your emergency rent money. Step 3, start small. A lot of beginners totally overthink this. They think, oh, I need thousands of dollars to even start. You absolutely don't. Today, you can begin investing with as little as $50. The goal right now isn't becoming rich overnight. The goal is simply building the habit. Consistency creates wealth, while chasing perfection just creates procrastination. Step 4 is keeping it simple. Seriously, skip the day trading, skip the crypto hype, and definitely avoid trying to get rich quick. The absolute most effective tool for long-term investors is the index fund.
It's a super simple investment that lets you buy a tiny slice of hundreds of companies all at once, completely bypassing the stress of trying to guess which single corporate winner will come out on top. It's diversified, incredibly low stress, and highly effective.
Step 5 is consistency. Imagine investing just $300 a month into the market. If your investments average around an 8% return annually, after 25 years, you could end up with roughly $285,000. But here is the crazy part. You only personally put in around $90,000. That remaining nearly $200,000, that is purely your money doing the heavy lifting for you through the magic of compound interest.
Let's head into Section 5, Seeds in the Soil. Think of saving your money like storing seeds in a cardboard box. It's perfectly safe, nothing bad is going to happen to them, but absolutely nothing grows either. Investing is taking those seeds and actually planting them in the dirt. It feels messy and a little uncertain at first, right? But if you yield to patience, those small seeds turn into a massive harvest over time.
Ultimately, we need both, but for entirely different reasons. Saving gives you the security to sleep comfortably at night. But investing buys back your time. It gives you options. It gives you freedom. And the earlier you internalize the massive difference between the two, the more powerful your future can become.
Because the reality is, the exact moment your money actually starts working for you, your entire trajectory shifts. So I want to leave you with this final thought to really reflect on as you look at your own accounts today. Are you still in the saving stage, or are you finally in the investing stage?